Hi, this is Randy Finney with Right Side of the Chart, and this is an early session update for Thursday, August 21st, 2025. It is 10:30 a.m. Eastern Time. I'm starting the video, and here's what we're going to do. Quick update on the markets. And yesterday I went through all the components of the NASDAQ 100, shared the ones that look like the most objective, better looking long entries. That was a smaller list than the objective short entries. So it was about a 3-to-1 ratio there. So you have those trade ideas. And again, the takeaway is obviously you're not going to trade them all. There's too many to trade. Take the ones you like or don't like, or keep it simple and trade the indexes. Obviously, if you look at a sector and index and 2/3 or more of the stocks look bullish than bearish, then you want to most likely be long that index, especially if the ETF or the index itself confirms. So that's one takeaway. What I'm going to do today is look at another sector, technology, and that's why I used the NASDAQ 100. It's not all tech, but it's mostly tech. It's technically speaking over half. Last time I looked a couple of years back, it was over 50%. And even those companies that might not be, have the label assigned technology, they really are. For example, Netflix. It's media, but it always started out as a tech company first to digitalize streaming content. Microsoft, Apple, Alphabet, Amazon, Meta, so Broadcom. Those are all the top components of the NASDAQ 100, and they're very, very much tech companies. So the NASDAQ 100 itself is just a concentrated view, if you will, to the tech sector. It mirrors XLK, the technology ETF. If you put the charts, they're going to almost be perfectly mirrored on top of each other. So that's that. The S&P 500 now, which is more considered the broad market, is comprised of 11 sectors, but the bottom 4, 5, 6 don't even move the needle at all. They're just 2-3% weightings. By far the largest is and always has been for many years now tech at over a quarter weighting. So if you want to know where the market's going, you just need to know where tech stocks are going. That's why I put so much focus on the QQQ and those Mag 10 stocks, especially due to their market cap weighting, meaning they have just like the NASDAQ 100, a much higher weighting due to their bigger market cap. And most of those are in the $3 trillion club or close to it. Okay, so we're going to go over now, although tech is very important to the broad market, it's not everything. So what I want to speak on today, especially, I like to, look at everything and do my best to provide unbalanced analysis. So from the bull perspective, I think even the most ardent bull right now would agree that a correction or at least some hot air coming out of the tech sector is healthy if it is a healthy, what we call sector rotation. So in other words, you take profit, mutual funds, hedge funds, pension funds, institutional investors, retail investors, they all take profits on their, NVIDIA and Alphabet and all that good stuff. And as long as that money is going elsewhere in the market, and lately we have seen a tick up in value stocks and in other areas, they refer to that as a rotation, sector rotation. And in a bull market, that is healthy. However, if money is coming out of most sectors or only going into the most defensive sectors, that's what I look at during sector rotation. Is it moving from maybe tech to healthcare or financials? Those are the second, third largest sectors out there in the S&P. So what we're going to do today, just to keep this short, I'm going to focus on primarily the financials. I'm going to start out again with a quick update. And before I do that, I just want to continue to reiterate the importance of the events on the economic calendar this week. We've already had the Fed minutes out. Today was jobless claims. Jobless claims, remember, you can access this economic calendar on right side of the chart. Go up to the top menu, click on resources. Below that, click on tools of the trade, and you'll have the economic calendar. You'll have the earnings calendar links. I use these on a regular basis, especially during earnings season. I'm frequently checking the earnings calendar to see who's reporting when, things that can move the market or positions you might have. And so if we look at jobless claims, remember, as I've been saying, and I'm not the only one, this is not a opinion or a debatable fact. The jobs market is by far the most important thing to watch in the stock market because consumer spending is about 70% of GDP. In other words, the government can pass all this fiscal stimulus and the IRA and whatever Trump may want to push through going forward, but it doesn't move the needle if the consumer is broken. So, and if the consumer has a job, they're spending money. If you lose your job, you're going to tighten down on the reins, right? That's a given, and there's no point in history where you've seen unemployment rates surge or spike and not had a recession that follows. So we're watching this. Today, initial claims have been pretty consistent lately, but they missed by a pretty good amount. We had a 235. It came in hotter than expected. Consensus was for 224, and it even was above the range right there. So market obviously and pre-market reacted negative to that. Now this can be spun both ways, and that's the funny thing, if you will, about a market, whether it's a bull market or a bear market. In a strong bull trend, good news is good news and treated as such. The market continues to rally, and bad news is either completely just shrugged off, dismissed, or in some way or another spun as positive. And so, and that's part of what you have to recognize, what kind of market you're in. So, if you want to spin that as positive, even though I believe it's a net negative, I have showed you many times. If you're new to the site, I'm sorry I haven't queued this chart up, but you can go back, look at the unemployment chart, go back as far as the data goes, many, many decades. And what it shows is you have a trough when unemployment hits record lows, which it's been at recently, and down around that range. It has never in history stayed at that level. It's always been relatively a V bottom. In other words, you can stay down around there for, a few months, year, but you don't sit there for 2 or 3 years at record low employment. For whatever reasons, just the way things are, when you hit that level, it's almost always a V bottom. And so the market for the last year or so has been cheering the record low unemployment, but yet, as history will show you, we don't stay there very long. And so what you want to start watching for are trends where you start that uptick. And I've already showed you the trend when you zoom in close enough, even though the longer term trend you can see was down, we're near the bottom. Short term, we've been ticking up like that. And it shows early making a reversal. And again, my point being that it would be a rare exception if we somehow had a little blip up and then stayed down here at these, towards the record low level of unemployment. So either way, that is what it is. Let's move on. The other things on the calendar today: Philadelphia Fed Manufacturing Index. The consensus was 0.8. Anything under 0 is contraction. So they were looking for a consensus was a gain of 8 points, and the range was from 2 to 13.3. So there's not an analyst out there that predicted a contraction. And so that's net negative. However, just like the jobs data today, now it's kind of quirky here, but I'm going to say typically, again, if you want to spin it as bullish, those that are clamoring for a rate cut and a reason to be long or stay long or add to longs, that helps support that, right? Given these two numbers in a vacuum, is going to be more fuel, more Fed voting members likely to vote for a rate cut at the next meeting. It's funny because yesterday I checked it, we were at 80%. Either yesterday or the day before. I checked it this week. And as of now, this was this morning, I'll refresh the page. It ticked down to 75%. And so I just want to talk on this real briefly before we move away and get into the charts. So let me refresh the page, see if that's changed since earlier today. 73.3, it's going down. Okay, a few weeks back, a couple weeks ago, and I maybe mentioned this a few times, that I'm not, it's not an outright prediction, but it's something that I think is a potential. And that is the fact, most of you, if you read the headlines, you know what's going on. Trump has been like no other president in history, just outright critical, given, too late Powell, always late Powell, whatever, given the moniker. Just extremely vocal, almost in a childish way, critical of Powell, threatening to fire Powell, et cetera, et cetera, et cetera. And we all know the whole thing. The Fed's supposed to be an independent agency, right? And now we know the latest headlines. Trump zeroed in on one of the voting Fed members who, supposedly, and without proof to follow, took out a couple mortgages in 2021, the year before she was appointed or hired by the Fed. And took out 2 mortgages and said they were a primary residence when they were really rental properties, right? Not your primary or second homes. Doesn't matter. You can only have one primary residence, so you get a lower rate on the mortgage, and that is mortgage fraud. I know that. I've owned 5 homes, so I'm very familiar. I used to work for a bank as a brokerage side, but that is a potentially serious fraud. But here's the point: is that would be typically overlooked. They're digging. He's obvious. He has his minions digging and trying to, he wants to have as you guys know, you read the paper again. This is all, it's not opinion of mine. He wants a Fed board that he can control. And now where I'm going with this, and this is what I mentioned. It's what is defined as, it would be a gray swan event. Most of you are familiar with the term black swan event. A black swan event, I'm going to just read it from another page. I'm looking at the AI definition. A gray swan event is a foreseeable but low probability event with significant potential impact, often underestimated or ignored until it occurs. It's a concept that sits between the readily predictable white swan and the completely unforeseen black swan. Unlike black swans, gray swans are theoretically imaginable and fall within the realm of possibility, even if considered unlikely. So what I had said before, and I'll say it again, if Powell has a set of cojones and wants to kind of dig his heels in and say, we're still data dependent. And again, this is just, some of these reports come in. One report shouldn't change anything. And in fact, remember, the Fed doesn't go off. We had a benign CPI last week, followed by a considerably hotter than expected PCE. And the PCE is the Fed's preferred inflation gauge. They've made that clear for many years. They don't use the CPI. They prefer the PCE. And so based on that alone, and the fact stock market's at highs, we don't see any distress in the credit markets. I watch credit spreads closely. I think Powell could make a solid case to still sit tight and watch, right? And so the gray swan that I predict, if he does, the Fed, and I've said this for many years, I'm the only one that knows this, the Fed in recent memory, in recent decades, especially since financial crisis, even really since dot-com burst, is no longer a Fed that surprises. They telegraph the crap out of everything they're going to do. They have constant, Fed, both voting and non-voting members going around the country giving speeches. Powell's going to Jackson Hole. They do not like to and will not surprise the market. It hasn't happened in years. So what I'm trying to say here, guys, it would be a gray swan event because I could see Powell saying something tomorrow at Jackson Hole, implying that they're going to sit tight, they're still data dependent, or and may lead the market to believe they're not going to cut. And if you see in a single day, remember yesterday it was 80%, you see the probability of a cut now drop below 50, market I think would poop the bed. So anywho, again, it's a gray swan, something that I think others might see that's a possibility. We'll see what kind of man Powell is and what Powell thinks. So just something to watch for, and as I've been saying for a while, something that has the potential to move the market. Now, if he comes out and either kind of says nothing but a bunch of big word salad, or he implies they're probably going to cut, see some weakening, maybe supporting, that's just going to go with the status quo here. It'll probably actually would uptick. If he comes out dovish and starts, he releases the doves, that's going to tick back up to 80, 85, 90 plus, and then the market, who knows? Again, I go off technicals, guys. A lot of this stuff's been priced in, so let's dive into the technicals. I just wanted to point out that is something, in my opinion, certainly to watch. All right, let's go to, we're going to start out this on the right side of the chart. I say this often. If you're interested in any particular post topic, or you just want to come in from time to time, questions, chart opinions, I post quite a few, and sometimes it takes me a day or two or even 3. I'll see a question that I missed, I'll post. So there's a lot of other charts, trade ideas that are posted in these comment sections, as well as updates for active traders. So yesterday, shortly after I gave you the video of the short trade ideas, and again, I made it clear before going into yesterday, all this, we had sell signals triggered last week. and they were verified. Started out on Monday that we were confirmed we were below the trend line breaks on SPY, QQQ, and then in this video, the last couple of videos I covered, I showed you that we had a lot of the, finally for the first time, which makes it different since the 200s were taken out, the majority of Mag 7 stocks breaking down. Again, they're the ones that matter. And I gave you guys, if you are an active trader, here, that's the second one, targets you could trade. So this was the first chart I posted. I gave you a preferred bounce target zone. I had a reaction here. That means you arrow breaks or a reaction occurs. I don't always have to, sometimes give you the how far back it's going to go. And so that was us going. Let me write this down so I can go to the live chart and show you what happened. 563.95, I think that is, and then 566.92. Second target. That's preferred. Preferred obviously is as it sounds. Max, just that's dotted, that's lighter shaded. That's a potential if things start to, if we take that level out, or I see something else, some Mag 8s regaining a breakdown level back above a trend line. But that was my preferred target. So basically it's going to 563.95, having a little pullback, and then up to 566.92. And this was it. I added one line cents. So there's the first target here, 563.96. We hit it, we pulled back, and I even gave you a follow-up chart there, right here, showing you where the pullback would go to, so you could short, get back long. Again, as an very active trader, most don't. What I'm showing you here, I know 90% of the people on the site don't have that. They're not full-time traders like me. My long-term accounts, I don't do this stuff. It's just my active trading account. This is active trading stuff. In, out, in, out, in, out. Sometimes I can make a dozen trades a day in the NQs when volatility is really high. Made a couple yesterday. But that's the pullback, and then has us going up to 566.92. I did a follow-up chart, slightly rises lower after that. I'll show you that in a second. But there's that first pullback, exactly where the arrows had it going to. Pullback, and then a run up to 566.92. We hit a high. I always tell you, if you're new to the site, I've always said on long trades, I give you the actual resistance level reactions likely. And I personally, and I suggest everyone sell a little below that in case the sellers step in early. We had a high of 566.89, 3 cents on a 567 point security is a tiny mere fraction of 1%. So that's effectively a perfect tag there. And again, you should always have, for that reason, sellers step in early. So that's, you game NQs, bouncing back and forth. Now, the takeaway is that's still resistance right there. 562.92 it was and is, and you can see the next resistance. If that's taken out, you can see if things get giddy. If the market likes what Powell's saying tomorrow, that alternative potential max target that I had may come into play. Now today we're going to probably grind around with Jackson Hole tomorrow, so that would come in something like this. So maybe that 570.10, 570.11 and downtrend line coming together. Remember, I do all these videos, they're long-winded in the charts I give you, because one thing I loathe is hindsight analysis. I will not provide it unless there's an added takeaway of, hey, I missed this, or here's something I should have done, or an educational example. So I give these levels an example so you in advance, so you don't have to post. Sometimes I'll see someone, hey, Randy, what do we do right now? QQQ. The levels are there in advance. That's, again, max bounce target, meaning if we take that out, there are other resistance levels, but something else may be going on. So that's my max bounce target. So what I can tell you now, and what I essentially was saying yesterday, by having that as a level showing a reversal, if we happen to take out my preferred bounce target, which so far has capped this, is that would be an objective short entry or add-on or re-entry if you gamed along off this support. That's it started out first, that's the support level. It's good support. You can see, it wasn't a random spot. We had a big old gap there, very technically significant. We had another second gap, dual gap support. That's the bottom of the gap right there and the top of the gap next to it, and then other reactions. So, and then if it goes, which I right now I strongly favor. Let me just be very clear. And again, maybe I'm right, maybe I'm wrong. Whether we go there or not, I'm kind of thinking not. I talked on that in yesterday's video. These hot, overbought, over bullish rallies with sentiment so high, short interest low, they usually don't let the longs out and the shorts in. That's been my experience. So therefore, that kind of leans me towards those lower bounce. That's why that was my preferred scenario, and that's only my max. And it's still a bearish scenario. It's just, do we bounce off this 558, 559 level I thought we'd bounce off? Do we bounce 1.5% like we did, or do we bounce 2? Okay, so we're talking a small range. Anything more, maybe something else is going on. Why? Because if we we start taking that out, we can start undoing some of the recent sell signals we had on both the equity indexes as well as those market leading stocks. And so this is still my next target right here, a level I expect, all other things being equal, I expect a reaction if we get there. A reaction is defined as when you're going down, you either have the ping pong ball dropped on a concrete floor reaction, or you have the hacky sack reaction. You trade in time and then you break it. Now, anything's possible. Again, we'll see what happens. No reason, unless you're a gunslinger, to go in heavily long or heavily short in front of Powell's speech tomorrow. That's just my 2 cents. It'll be over. We'll kind of have some clarity, hopefully afterwards. And I'll let you know what I think, over the weekend. Friday is always a interesting day for swing traders, because swing traders, unlike day traders, swing traders have overnight risk. And on Friday, when the markets close, even for you futures traders, you have those 2 days of overnight risk. So extra things can happen over the weekend. And so I'll let you know there. All right, so that's QQQ. That's how it's played out. That's what I think is going to happen. That's still probably where the rally ends. If you look at the PPO, you put it on the 0 line, which I just did there. When you're below it, and remember, we've been in a strong rally, but when you're below it, you're in correction mode, and we're still below it back testing. And the other thing is, I have to go back farther. I can't scroll back that far on a 15-minute chart, but when you get into bear trends, this line, the 0 line, delineates bullish and bearish trends, and you can see on this, on the bull side, and I always use this one, the white line. It looks like light blue there, and let me make it white so it'll stand out, or for kicks and giggles, we'll make it purple. All right, so in a bull trend, since this line delineates bull and bear trends, typically it's the pullbacks to the purple line there, the 0 line. Sometimes you'll whip a little through there, but a lot of times you bounce right off it. It acts as support when you're above it, when that 9 EMA, the signal lines, and resistance when below. Boom, boom. Look, we broke it there, tried to get on it, rejected, tried to get on it, rejected, and we're back testing now. So that's where we're at, guys. And that's just one of many trend indicators. It's not the be-all, end-all, but it's one that I like to use. Okay, let's dive into the rest of the charts. There's QQQ, as I've been mentioning. There was the breakdown, nothing but red sticks, so you don't have to squint to see it. Chances of a whipsaw are very low. Maybe that's it. Look, again, there's Powell tomorrow. A lot can happen. Big earnings lately. We're starting to see a trend with earnings go the other way. Even when companies beat, you're seeing some big sell-offs. And that's what happens. In a bull trend, again, the narrative, no matter what happens, they shrug off bad news. Good news is good news. And then all of a sudden the narrative starts to change. We'll see, guys. So anyways, this is on the daily chart. This is my next target or support, even though this says T1, because these are targets I gave you back here a while ago. And they're still potential targets. So let's just see what happens tomorrow and into next week. Again, no reason to be aggressively anything right now, in my opinion. But let me show you the other stuff. And I'm going to focus on, again, I did an in-depth analysis of the MAG 8, 10, top 10 components yesterday. And so I'm going to go to the second largest sector after tech, which is financials we're going to look at today. There's the SPY, clear breakdown. You don't have to squint to see it. And really not a lot of support. We're still right off highs. I guess why you can't get like overly bearish. This is the second. We had a half decent correction there. This one's about the same. That one was quick. Over in 2 days, before you know it, the dip buyers gobbled it up, and maybe they do that here. And then I'll just tell you right now that if they pop it and make a marginal new high, it's going to be a divergent high. That doesn't guarantee it'll fail. It just guarantees you'll still have the negative divergence, and the odds for a failure are going to be higher, but we'll see. All right, just like this one. There was a breakout. As I predicted, it would be a marginal new and still divergent high. Broke out, took out the previous high, and now it's back below it. That's a failed breakout. And if we go back up, then so be it. All right, financials. XLF is the financial sector ETF. On face value, well, again, if you turn off the lines to the untrained eye, they see something that's pushing about to break out to multi-year highs, and maybe it will. What I see is a sector that continues, the second largest. Again, I haven't updated this in a little while. It's been almost a year, but these numbers change somewhat throughout time, not too much. It's the second largest sector at half of what the tech sector. So it still moves the needle. It's just those tech stocks are going to move the needle a lot more. But again, when you take this and healthcare and financials combined, almost equal, roughly equal the tech sector as far as the weighting in the S&P 500. And this is what I talk about: divergent highs with overbought conditions and negative divergence tend to fail. That was a breakup, but we failed. Then we made a new high. And you can say, all right, I'll keep buying that pattern. Randy, you're right. You point out that the divergent highs, often go back in and fail and go back below that high, but then they keep going to new highs. So why don't I just keep buying the dips? You can. You do I do me. What happens when I look at this chart, I also look at the longer term charts, the weekly chart. And what I see here is a weekly divergence that's been building, and those weekly divergences, or when you look on this smaller time frame on the daily chart, you have a series of divergences. It's usually that triple tap, I call it. It's typically that third divergent high that does the trick. And remember, each one gets bigger. Each correction is usually bigger off each of these consecutive. They're all part of the same divergent high. And then finally, it leads to the one that really breaks things. So now we're above the 200s. We're above support. If you want to know the levels to watch on the financials, I believe I already have alerts set. You want an alert set around 551.30-ish, give or take. That's resistance there. We broke out, successfully back tested. We've been back testing it here. That is a technically significant level. Short sellers will short under that level, and longs have their stops under that level. And so that should take us down to the 200s. Next support, if taken out, 49.53. And as I say, if you are bullish and you want to get in the market, you want to get in the financial, all these levels that I'm looking and expecting a likely breakdown to initiate or add to short positions are the same levels. You can take the other side of the trade and buy pullbacks to those supports with stops somewhat below. So it's, where do you think things are going? If you're trend trading or investing, then these are the pullback levels that I can tell your objective to add to. But if taken out, then you might consider stopping out. Now, if you think that we're going down, you don't want to buy pullbacks to support, because that support level is probably going to break. So you have to pick a team, be it bull or bear, and then your trading plan is. I'm showing you the levels. Again, that's where my skill sets lie, and then I'm often trying to predict what's going to happen at those levels. But you decide which way to go on those. So, and again, when I look at the weekly chart, I'm just going to measure it for you here. Rough measurements. These are all the divergent highs in the last, going back to all the way back in 2015 here. That was a 28% drop in the financials. I got to start a little high there, and I'll stop a little low, just about 27, roughly the same percent drop. Here's a consecutive larger divergent high. That's COVID, 45%. The next divergent high, which ended with a divergent low, 26%. So there's the pattern. Even in a bull market, nobody can argue, this is not up for debate, that we're in a secular bull market since 2009 in the financials. But what happens is every now and then you want to come back and check your primary trend line. And every now and then, every few years, I should say, you put in negative divergence. The rally gets there, everybody's bullish, the market's going to go up forever, blah, blah, blah. Short interest is low, and then you have those 20, about 30% drops. So I think it stands to reason, and we could have another 30% drop, 28, whatever you want to call it, coming up soon. Let me just measure. Then let me take that trend line I already had there. Let me just extend it out. See where that would come in. 23%. And that'd be a nice support level too. So if you're kind of wondering longer term, if you want to buy puts, whatever your thing is, or sell credit spreads, or buy or sell, whatever, that's a target right there. All right. And then if that goes, this is a even bigger level. Now, somewhere I think we're going over the next year or so. That bounce, come down there. Okay, let me dive into the components. As I often do in these videos, when I queue up an index or a sector like this one, I have the components on my right. I have to move the screen over so you can see them. They're sorted by market cap, with JP Morgan being the 800-pound gorilla in the financial sector at $807 billion, Visa 641, and then they go down from there. So I do that too because obviously the bigger the company, the bigger the weighting is typically in the sector. So let's look at the individual component. Oh, before I leave there, oh yeah, I already covered the levels on financial. We need to break 51.30. I'm sorry. Or you have a reaction low there if you want to play it safe when they take out the low from that August 1st candle. The low was $51. So if you want to be, safe there. Now there's always going to be support levels. There's a gap right there. It comes in a 50.80, but I think that level will do the trick, about 51.32 on a solid, especially a closing basis. Let's rifle through the rest. I'm just going to give you the levels to watch and the technical posture. This was a divergent high there in JP Morgan. Oops, that's not what I wanted to do. I deleted instead of copied. Divergent high. As I pointed out at the time, we shorted the Financial Zen. One of the biggest drops in years. It was just to get an idea. JP Morgan went down 28%. Remember, we were covering all lows on the morning of August 5th, or all shorts, going long. No shorts, all longs. Then you have this uptrend line right here. You can see it. And that divergent high right there was DH1. This is just an extension of the existing divergences. I need to add another line right here. Divergence is getting steeper, meaning the slope of the line going down more at that most recent divergent high. And we're walking up this trend line. So we need to take that out to trigger a sell signal. And I'm going to give you a horizontal line here that needs to go. This is your previous ATH right here, all-time high. We broke out, had to break out the new highs, back tested it. And so that level 2 will be, that's the BOD or benefit of the doubt level, about 280.19. Or you can call it 280 if you want to round down. Visa is an active trade and has been. We shorted it, I guess, back here on the breakdown. You can reference it. Go to the trade, short trade ideas. You'll see it there. All the charts. Just click on it. We hit my first target here, my second target there. Third target here, we hit my third target again, which was also the 200-day moving averages. Obviously, the traders are going to buy. It's almost not a guarantee, but close to a guarantee that when you get pretty far away from the 200s like this, and that was the last time we hit them, it's like Pavlov's dogs. They're going to, dip buyers are going to step in and buy the 200s. But the fact that we hit them just relatively recently is pretty weak. So you can see, Visa's losing momentum. I expect them to go. I'm still maintaining T4, and we'll most likely, let me do it now. I'm going to do this in the video, make it official. I'm going to give you a T5 based on my analysis of the charts, including Visa. I think it's time to add a fifth target for those of you in it. If you're not in it, because it's been a while, we've had some bounces. I'll tell you right now, this is an objective short entry here that bounced back to T2. Remember, my targets are based off support levels where reactions are likely. We hit the first one. The first tag at T2 and we bounced. That was a big candle there, big bounce. Then we hit T3. As expected, we bounced. And then T2 has been acting as continues to act with support here and now resistance. So I can tell you with confidence that this is an objective level because we're just below T2. If it pops that level, T1's been traded through too much. So the next resistance is going to be about right here. I'm going to put a line for you right now if we happen to get up there and you're interested in shorting Visa, or you want to go long on a breakout. 358.74 is the level. And there's your next targets. And remember, this is the uptrend line. The primary uptrend line comes in around T4. So the way this works for me, depending on what's going on at the time in the sector and in the market, if we hit that trend line first, they're probably going to step in and buy it there. Or intraday, go through there, hit my 3240-ish level. Remember, cover a little bit above that if that's your plan, and then park the day back on that trend line. Usually you're going to have at least one last hurrah off the primary uptrend line, like right there. All right, let me go a little faster on the rest. MasterCard is also another credit card company. We had a short on it back here, and we hit we hit T3 back there. That was T1, 2, 3 right there. That was created back on 121.25. And there's, it was really nice support. It's also another potential target. If we go down again, that would be a drop of about 21% MasterCard. I can't guarantee that's going to happen, but I guarantee if it does, the stock markets are going to be rolling over. These are the tell on the economy. These are the credit card companies. What happens, consumer defaults in a recession, or people start losing their job and they're not paying their credit cards. Yes, they make money on interest, but then when you start getting a lot of defaults, then they start to have to write off those bad debts. Bank America, divergent high. Okay, same story, guys. I'm going to go a little faster here. I'm probably putting half of you to sleep. But again, these are some trade ideas in here. And you can see these, look at the chart. Divergent high, boom. That was a divergent low right there. You can see the divergence line. I didn't put the DL in there. Rally, divergent high, drop. Clean, big, divergent low, rally. Another drop, divergent low, rally. Divergent high, big drop. How much did we drop off that divergent high? 31%. This was a divergent high followed by a recent sell signal. Remember, divergence isn't a sell signal. It's a condition. What's a sell signal? A break of a very, very well-defined trend line like that, or a back test is an objective entry if you missed the breakdown or you took only a starter position. And boom, breakdown. There's your trend line right here. Been moving sideways and needs to take out the 200s, and then this one's probably going a lot lower. Berkshire, one of the better looking ones, shorter term. It was recently put in a little divergence here on the PPO, but it also took out as you know, Buffett stood down, and Buffett was Berkshire. So a lot of folks have, taken out, but technically it's broken down. All I can tell you, it's at resistance now. I can tell you with confidence, this is an objective short entry here at the 49.74 resistance level, and the 200s, by the way. Turn off those lines. 200s, you want to buy in a bear trend. When you take out the 200s, it's bearish. You short rallies back to the 200s. And then once the 200s are regained, you buy pullbacks, right? This is easy stuff. It doesn't always work, but it works much more than it doesn't work, more often than not. And so what happened to Berkshire recently? Broke the 200s. What happened since then? Rejected. And it's there right now. So on a scale 1 to 10, this is a 10 in technical analysis for shorting Berkshire with a stop somewhat above. Somewhat is relative to where you think it's going. It broke a major uptrend line, so I think it's going quite a bit lower. I think down here, so I think there's going to be 20%, 20% downside at minimum. And therefore, let's say you use a 3-to-1 stop. You can use a 6%, 7% stop loss. It's going to put you, if you shorted it here, it's going to put you about right there. And that's also resistance. How I trade, I look at, if the 6% number was right there, I'm going to stretch it out a little and put a stop a little out of range because that's resistance. I'm not going to set my stop right below resistance because if they pop this level, they're going to go there. I want it a little bit above there. Ideally, I like to do on a closing basis. I've learned a lot over the years. They pop stops intraday, and once the stops are cleared, the downtrend resumes. So, I have the luxury of being in front of the computer. I don't think you can set that as an automatic thing with your broker to only set the stop on a closing basis. And what's a closing basis? You can wait to 359, 358 and see if it's going to close above or below, or it's, close it out in after hours. You have a lot of liquidity and things like Berkshire in the after hour session. Wells Fargo, divergent high. All right, guys, so you get the point. I'm just going to divergent high. There's support. There's the 200s. I'm going to rifle through the rest. Morgan Stanley, birds of a feather, guys. These are the banks. The insurance companies have already broken down. They're weak. They're part of XLF. XLF is not just banks. It's all types of financial companies. Goldman Sachs just broke down, offering an objective short entry. Breakdown yesterday, still down today. This one's still an objective short entry with the next sell signal or add-on to come on a break below 692.84. AXP, I gave you, I guess this one, we had it as a trade idea here. You're going to find very few services that can, identify targets with such precision. That was created on 12/19/24, updated on 6/10/25. I may have added it, modified. Update would have been when I put the hit in there. So we shorted, I guess it was a breakdown right there of the beautiful uptrend line. And, if you stuck with your trading plan, you made 27%, and then you turned around and either covered it, because again, that was probably the morning of August 5th or right before there, started covering shorts. April 7th, that T3 was hit, and you got that. And so not only could you have made 20, almost 30%, but you could have turned around, bought the stock, gone long. And this is swing trading. Divergent high, boom. Divergent low, by the way. It's not labeled, but it's marked divergent low, rally. Divergent high, sell signal. I gave you the same stock as a new trade setup back on, I guess, if I give you these targets on 6/10/25. When was 6/10/25? July, right there. So what did we do? We made a marginal new high, but still not within any, it didn't exceed any reasonable stop. Oh, it would have been on this breakdown right here. Yep, that's it. So there's your entry. The stock went up another 9.4%. Final target is 39, so about 40%. So that's well within any reasonable stop. I like to use at least a 2-to-1 RR. Depends on the trade. 3-to-1's a nice one as well. And so that wouldn't have exceeded any reasonable stop for anybody targeting, swinging for the prize, the long-term targets there. And so it's looking good so far. We had a little minor trend line broken here. Probably want to see, you want to see it for sure. You want to see it take out the 200 days. And then that'll open the door to these deeper targets. All right, let's move a little faster. City, divergent high, broke down. No breakdown yesterday. That's what we call a stick save, guys. See, this is why it's on a trading and daily chart. It's not a bad idea to wait to see a daily close. So we close back on the trend line here. This gives you what we call an ascending broadening wedge pattern right here. It's like a megaphone pattern, upward tilted. That's just your divergence line there. And then this is the breakdown today. Again, you got Powell tomorrow. What Powell does will move the financials as much as anything. Or what he says, of course, what he says tomorrow. They're not going to. So, but it is a breakdown, and if you want to take it on face value, you can. Again, I'm talking scaling in, I think, is the way to go right now, not an all-in aggressive thing. Breakdown in BlackRock right there. There's your uptrend line. All right, so you guys see, I can sit here all day long. What you're going to see are the first divergent highs in months, really since the beginning of the year in January. And the last time BlackRock had a divergent high, it broke down first from the trend line. But as I often talk about, just like the stock market, guys, sometimes you break down and you don't look back. But quite often, you break down, as we did here. You go on to make a marginal new. That was a new high over the previous high, but still divergent high. And then what happened? The stock fell 28%. And if you want to argue that technical analysis had nothing to do with it, then you shouldn't be on the site. That's primarily what I do. I'm a firm believer in it. It doesn't always work, and when it doesn't work, most of the time, I might have an incorrect read in the charts. I'm missing something else. Again, nothing is 100%, not even close to it. Nobody bats 1,000, not even close in this game. All you can do, you can make money batting 500. 50-50 win-loss ratio if you're using favorable RRs. If you're using a 2-to-1 RR, you're risking $1 to make, or your 1-to-1 RRs, I'm sorry, you risk $1 to make $1, and you only have a 50% win ratio, you're going to spin your wheels, and the only person getting rich is your broker. So again, everyone's different, has different trading styles. The more favorable your RR is, the more you're going to get stopped out on those trades, but the lower your probability has to be, your win rate. All right, so let me go on. I'm going to get to you can see here, Schwab, nice one. I just see a lot in the financial sector, guys, and that's why I wanted to do this video for you. I did the tech yesterday, but remember, financials are the second largest sector. What I'm showing you is they haven't rolled over, but I think they're about to. And then therefore, as I started the video, I'm telling you about sector rotation. If the tech wreck continues or has only gotten started, as I believe, that's my belief based on the charts, there's more to come, whether we bounce tomorrow, next week or not, and the financials buckle, they can rotate all they want into utilities. Utilities, XLU, just so we can get back here, makes up, again, last time I did it in September, 2.25% of the S&P 500. Tech, XLK, is 32.4, right? You follow me here? So XLF, 12.42. All the money in the world can go into the utility sector. It's not going to move the S&P 500. It's certainly not going to move the NASDAQ 100. So this is my point. If you're a bull, you want to see healthy rotation into sectors that are going to support the market if you're trading index funds. If not, I do these videos too. You can make a lot more money than the broad market. That's what I tend to, I get a little frustrated when people just focus on the QQQ or the broad market calls all day long, all week long, all year long. I'm focused on multiple stocks, individual sectors, some of those not even in the S&P 500, agricultural input stocks, lithium stocks, commodities, agricultural commodity ETFs, things like, or the MOO, which holds the, ag input sector, or the, John Deere and companies like that. Let me go to back to Excel. Oh, let me show you, and I'm going to wrap the video up, a sector that is really on my radar, and that's the broker-dealer sector. There's IAI, which is the it's an ETF that holds the U.S. broker-dealer index fund. That's Morgan Stanley, Goldman Sachs, Schwab, which I've already covered. They're part of XLF as well, but this is a subsector financial. I'm just showing you the charts. All these guys are ripe for breaking down. Ripe. I mean, they all same story. They're all singing the same exact song. Big divergent highs, nice support shelves they're flirting with right now. So they either defend that support, as I often say, I'm going to say it again, support is support unless broken. So I might get excited about some of these setups. These are setups in the financial. The financials haven't buckled. They're just off their highs, but they're sitting on key levels. And then if that one goes, for example, this is ICE, Intercontinental Exchange, 178.38, that breaks. My next support and target is down here, the intersecting 200-day moving. It's triple support. It's massive, in my opinion. It's the 200-day simple and exponential moving averages with very nice price support at 168.54 and the primary uptrend line. Guys, it doesn't get any better than that. So, again, if you are bullish and you like this stock or this sector, that's a 10 on a scale from 1 to 10 for an objective long entry on a pullback to those triple intersecting key support levels. However, if you're bearish, that's also a 10 on a scale of 1 to 10 if it clearly breaks that level. All right, so you, again, decide how you want to trade it depending on your outlook of the market. Set your price alerts. Maybe you're a part-time trader. You can set buy orders. You can set a good to cancel buy limit order that says buy ICE if it falls to 170, right? And you can also, on the flip side, set a sell limit order, good to cancel, if it breaks that. So if you're not around when it breaks that level, you can automatically have your broker fire off a short entry trade by using what we call sell limit orders. Depending on your broker, you might have to categorize as a sell short. Interactive brokers I love because they don't differentiate. You just sell something and they already compute. Whether if you don't own it, they know you're shorting. And if you own, 5 contracts NQ and you sell 10, it immediately sells out your 5 long and puts you 5 short. And with one commission, one trade. That's again, Interactive Brokers is geared for professional traders and has a lot of advantages for active traders. All right, I'm gonna just rifle through the rest. Oh, let me do this GS because there's some in here that when I type in Goldman or Morgan Stanley, it's going to give me the capital markets sector. It's going to show me more stocks than an IAI. I'm going to rifle through these very fast. There's a couple down towards the end. You can see this is Robinhood, HOOD, Raymond James Financial already broke down off that divergent high. Last time we broke down below a trend line following a divergent high. Raymond James fell 27%. TradeWeb already broke down following its divergent high down below the 200s, currently at support 126.68. Again, just pause these videos or put them in slow-mo. I'm going to rifle through because this video is getting pretty long now. Right on, this is LPL Investments, right on the 200s and a support zone. Once that goes, this one has a lot of thin air. There's minor support here. I'll give you a target. And again, if you want expanded charts or say, hey, Randy, you hit on XYZ in the video, are those your targets? And I'll update a chart. Some of these lines I've had on here for years, and I don't update all these charts. I went in recently, updated the most recent divergent highs, but a lot of them are breaking down, guys, and this is it. So if the financials go, that's, in my opinion, not the last pillar of the market. The last pillar in the market that start a much bigger correction or bear market is credit spreads. I'm watching those closely. I've talked about it. I believe that they're grossly underpricing the risk in this market right now based on credit spreads. So there's a huge opportunity there. And if credit spreads blow out, you won't be able to get into this market short fast enough. You're going to miss out on a big move. And I know I've been talking about it for a while. And when those things happen, I'll let you know. They haven't happened yet. We didn't have breakdowns in the FANGs since the 200s were recovered recently until just now. This is FUTU, beautiful bearish rising wedge, negative divergence. You see all my targets. This is a stock that I believe, if I update it within a year from now, will be down 60%. NMR, Nomura Holdings, I believe that's a Japanese broker. Beautiful, just starting to crack right there. So there's a story. HLI broke below the trend line, kind of moving around sideways. JEF, Jeffries, needs to break that trend line. Rejected off resistance in the 200 simple moving average right there. And then when I go down, there's some that I see. I'm going fast. I know I'm doing this on purpose, guys. You're not going to be able to keep up with all these SF broken down. There's some brokers I see, and I do this from time to time. I want to look for red flags in the market. Now, most of these are little. This is eToro. Now, again, it doesn't have a lot of trading history, but this thing's in free fall right now. So if you have money with eToro, it's a new digital one of those online brokers. You might want to be careful. I'll be looking for cracks. There's a nice setup right there. PWP, all these guys, a lot of these have either broken recently support or close to it. DEFT, I don't know, I've never heard of them. DeFi Technologies, but again, if you have money there, things headed down straight path towards zero. Something's going on there with those brokers if they're being sold like that. So just be careful if you have any of those newer startup online brokerages. Siebert, something's going on there. Prop. See, I'm just clicking through, and it just takes me cycles through the watch list and order market cap. So remember that too. When I get down to these names you see in free fall, they're not going to move the needle. They usually won't blow, or you have present a problem in the market, but I have seen it. If a broker, and they were overly leveraged, the broker itself, and has a problem and they go bust, there have been times where that puts a ripple effect through the markets. I mean, obviously if a Goldman busted out, that's going to take the whole financial system down, or has a potential or a big part of it. So that's it. I've cycled through them all. You kind of get the gist. I don't want to beat a dead horse anymore. So we have some early sell signals, early breakdowns. Doesn't mean that's it. The sector's going to zero. It just means, hey, they're objective short entries with the next even more important levels. Again, that would be my BOD, benefit of the doubt level on Goldman Sachs, 692.84. Very nice. This is a breakout to all-time highs here. If it fails, that's bearish. It's probably going to take Goldman down at minimum. That's what I call a high probability price target. If 692.84 goes with conviction, then Goldman's going to go down to, I have a high degree of confidence, 623.50-ish right there. That's a 12.5% drop from where we are now, not from the highs, from where we are today. That's going to come in perfectly with the 200-day moving averages, and they'll buy it there. So you could short Goldman down, make 12%, turn around, bounce it, if and only if I can make a case at the same time to go long Morgan Stanley, Schwab, Robinhood, the other brokers, or XLF, or IAI, the broker-dealer ETF. In other words, if Goldman hit this level, and at the same time, IAI, XLF, JP Morgan, everything else is just breaking down below support or has already broken down, and I can't make a case to buy the majority or the big financials, I'm not going to step in and try to game a bounce on Goldman Sachs. So hopefully you kind of know that's how I trade and kind of take it all collectively, and the broad market too. I'm not going to sit there and try to game a bounce off Goldman if I'm short covering in there. And then the S&P and Nasdaq 100 have just cracked major support and are going lower. They're going to take this down with it, and everything else kicking and screaming. So that's why I do these long-winded videos, starting out with the equity markets, kind of big picture, because everything's intertwined, especially this sector, again, being the second largest of the S&P 500. If I'm talking about those agricultural input stocks that was trading actively last year and earlier this year, I could give two flips what the S&P 500 is doing, because there's virtually no correlation there. So they kind of march their own drumbeat. But these big companies that are indexed heavily, it's out program trading. Money flows in and out of the stock market. So keep an eye on the major indexes. Keep an eye on the sector that they trade in and the big names in that sector. Okie doke. I'm going to wrap it up here. This has been Randy Finney with Right Side of the Chart. Have a great day.